What's up, guys? 7 Wall Street here. So this video, I wanted to cover on how to do an option spread and how to kind of play earnings, right? So we have this stock today called Keys, Keys, and before earnings, the stock is trading around 134 to 140s, and we have a resistance in the daily here at 142, right? So if we wanted to play earnings, we'll assume that it's going to be able to get by this resistance from here to above that. So anything above 142 would be what we're looking for, because that will spike past the resistance. Okay, so let's take a look at the $142 contract. So there isn't a $142 contract. The only next contract is 140 or 145. The 145 is $3.70, which means in order for us to make money, it has to be over $148 or over that, right? So it has to be over $148 for us to make money, which means there's a huge premium on that just for us to break even. No, not even talking about making money, but just breaking even, right? We're paying a $3.70 premium. So one of the ways you can play this is using a debit spread. Now, a debit spread is this. So you go here, type in KEYX. So if we think it's gonna, if we think the next season is 142, if we could break 142, it could probably hit 145 and over, right? So we'll shoot for 145 and over. So do a debit spread. Let's see how much 140, 145 is. So if we want to bet that it's gonna go from 140 to 145, it's gonna cost us 220. Our break even is anywhere above 142, right? Now, if we want to shoot above that, 145 to 150, our break even is 146 plus. Our cost is $137. So it's a little bit more than this one. This one, that cost is 220, and our max profit is 280. This one, our cost is 137, and max profit is 360. So this is a pretty good reward, 2-to-1 ratio here. I like this reward. Risking only 137, but we have the potential to make double that money. So the 2-to-1 ratio. So what you're doing here is you're gonna buy the $145 calls and you're gonna sell the $150 calls. What happens when you do that? So that means if it opens tomorrow anywhere from 150 and up, you make money. Now, you only lose money if it drops below if it drops below 141. Usually if it drops below 145, if it stays below 145, you lose money. That's how these debit spread works. So you're essentially buying this contract, you're buying the 145 in the money contract, and you're going to sell the 150 out the money contract. So that if it goes above 145 to 150, if it stays above that, you're going to be in a shit ton of money. So as you can see today, it's at 154 after earnings. So if it's 144 and opens tomorrow, you would be up $190 plus. Now, it'll naturally continue to go up more as IVs decrease, and then when it hits the end of the date, you'll make even more money when you hold it till expiration. So how do you set up this play? So you just go here. We're going to use Robinhood as an example. So we're talking about buying the 145 in the money call, and then we're going to switch from buy to sell. Now we're going to sell the $150 calls, which is here. So we're going to buy the 145. It's going to cost us $3.70, and we're going to sell the $150 call, which is $2. So which means the total we have to pay is only $1.70, right? Which is a huge discount. It says actually it's even less, right? So it says we can get it for 1.38. So we'll probably shoot for an even number, which would be 1.40. So that will be a total cost 1.40. And we're risking 1.40 to make 360 at max at the most. But if this runs like really hard tomorrow, if it goes like 170, you hold it for like a week or two, or even 160, you'll start making a lot of money. You'll be making 200% almost. So that's a pretty good bet. That's pretty much what debit spread is. Is one of the best ways to play options, but also not have too much risk. You have a limited amount of reward, but you also have a limited amount of risk. But what it does is limit your rewards a little bit less than your risk. You can still make 200-300% on the trade, but let's say if it stays flat, this is where it helps you out a lot, because when you play earnings, You have three options. It'll either run up and make you a lot of money, or it stays flat and chop and you don't make money, or it goes down and you lose money, right? So if you play regular options, if it happened AM2 where it chops or if it goes down, you lose money. So that means you have like 66% chance of winning. With this strategy, let's say if the stock price stays around 139, you're only losing 5 to 10% at most. So you're not losing a lot of money. You're only losing very little money if you're wrong. So that means there's a better odds for you to make money with this strategy than the other strategy. So I hope that helps. As I promised, doing about the debit spreads, I'm pretty sure this is going to be a little confusing. So feel free to ask more. And now I feel like I could probably make a way better video on this. I'll try my best to make even a better video on this.